So this is what we look for. As Mike mentioned, we look for cash flowing assets. We're not into new development, we're not into speculation, we're not into let's see how this may turn around. We want stabilized assets. These are stabilized businesses that we're going in and we identify an opportunity to add value, to improve it with management or whatever. But at the point of acquisition, it must stand on its own. This needs to be a cash flowing asset. We're not interested in taking something over that, for a few months we're going to have to fit the bills out of our pocket before it cash flows. This business needs to be operating and needs to be self-sustaining for us to then move forward. Value add opportunity, as Mike mentioned on that as well, and the forced appreciation. There must be an opportunity for us to do the $40 rent bump and a $10 expense saving. And for a couple of reasons is one, that dramatically increases our equity and our return. But two, if something, we go through a cool-off, which we are very, very mindful that there probably is going to be a cool-off. I know everyone's got their own opinion of the market. And if we've built up equity beyond from what we purchased the property at, if there's a cool-off and things come down a little bit, we've got more of a buffer for handling that correction. So that's why we like the value add. We focused on the Midwest and Southern states, so we saw the Mid-South, Texas, Oklahoma, Arkansas, Kansas, Missouri, Arizona, Florida. We'd love to get in here. It's just a bit of it's always tough breaking into a new market, so we're staying where we're strong at the moment. Business and landlord-friendly states. So I'm sure some of you have heard perhaps about rent control. We don't want to be investing in states that have rent control. Most of the states, Texas, we get a 3-day notice to vacate. So if someone's late on their rent, we give them 3 days. We can basically evict someone within a month. Oklahoma's 5 days. Arkansas is all the same. We need landlord-friendly environments. We do care about our residents, but we also care mostly about our investors and the business. This is a business. We're not housing people who cannot afford to support the lifestyle, and we do take care and pride in the community so that people want to be there. But if they're not paying their rent, we got to get you out. Good market fundamentals. We want markets that have increasing population, increasing job growth. There needs to be a catalyst in the area. We're not into, we see a lot of deals all over, but if there's no underlying reason of, why we would go there or why, we don't really want to invest anywhere where, it's just plodding along. We want to see activity. BC, as Mike referenced, and we've showed the pictures, typical construction, maybe as far back as 1965 to the 1990s. There's obviously some give and take on that. And that's also how the properties have been maintained. There's a property in Jacksonville that it was built in the 70s, but this thing it's really well taken care of. I'm going to say it's borderlining like an A-class property with all its amenities. So don't think of it as 1970 property. If these things have been kept up, they really can have all the modern stuff we need. And the deal should support on-site management. We need to have resource on site. We have our maintenance guys living on property. We have a property manager living on property. So we try to always have someone living on the property who works at the property. That way, handling after hours calls. We just took over a property in the week of Thanksgiving, and we moved our maintenance guy on site. And the residents are just so happy that they now, after hours, have someone who can handle just anything. It was one of the first thanks we got from residents is, previously 5 o'clock would come and they wouldn't see anyone until 9 o'clock the next morning. And if anything happened, you're on your own. We've now got staff on site who, can handle and offer the service that we want to give to residents.